Welcome to the Money Multiplier Infinite Banking Concept, how to become your own banker, full 90-minute training. Now, we probably won't go a full 90 minutes. We're gonna hash it down. And what I'm gonna do here with you right now is I'm gonna give you the facts. I'm gonna give you how this works, why it makes sense for you to implement it without doing anything different than what you're already doing right now, and the effect that can have for you and your family, not only immediately, but definitely into the future, and the legacy that this will create. Now, I know that's a lot right there. And so I just want to make this very clear that what I'm going to teach you is not hard. Anybody can understand this. Anybody can implement it. It's not hard whatsoever. There's a little bit of mindset shift that we might have to undergo to fully wrap our heads completely around it. But what I'm going to teach you right now is very simple. And so I'm going to give you some homework. I'm going to give you some things that you got to do over the next couple of days to go along with this stuff. But let's have some fun with it. And my name's Stephen Nagy. I'll be your trainer. I'm what's known as a money mentor when it comes to the money multiplier. In reality, I've been investing. I was a financial advisor at a college, got into real estate investing and entrepreneurship, and I've been doing that for the last 14 years. I've also been coaching and training others in investing strategies, on real estate investing, on money. Ever since I was a financial advisor, I never really stopped. I just always implemented and taught, and learned new things, and built a beautiful network all across the country. So that's some of the things that I'll be sharing with you tonight, just some of my experience and stuff that I've done. So, hey, Jermaine, welcome, man. Thanks for being here. All right, so a lot of what we're going to talk about tonight is going to be money and opportunity. So we get deep on the markets, we get deep on history and what drives us to where we are today. And it can help us predict, not time the markets, but predict what's going to happen next. But I don't have time to talk to you about all that stuff tonight. So those are on other webinars that we do. So every week, I put on 6 different live webinars with my team. So tomorrow at 9:30 a.m. Eastern, Chris and I are doing the What the F Happened live stream podcast. So you can watch that on social media, on YouTube, but we live stream this. And this is where we talk about what's driving the markets. We talk about history. We talk about policies that are coming out and what's driving the markets up, down, and what's going on with your money. So join us for that. Tomorrow at 1 p.m. Eastern is our Wealth Webinar Wednesday series. These are weekly shows every single week. So tomorrow we have one of the top crypto investors in the country coming on at 1 p.m. Eastern tomorrow. So we do an Ask Me Anything every Wednesday afternoon. I do a business building and precious metals every Thursday, a Money Club Mondays, real estate investing every Monday. So we have lots of webinars. So I'll share those webinars and that schedule and how to watch all those with you here in just a second. I'll send you the link for that stuff. But I just wanted to mention that this stuff's very important. And I do believe that everything we see happening right now is going to create a lot of opportunity in the coming years, a lot of opportunity to create wealth, a lot of opportunity to really become a millionaire if that's what your goals are. And so we'll talk more about that on other webinars, but I just want you to understand that we do have a lot of opportunity. So now is the time to start understanding, where is our money? What are we doing with our money? And how are we preparing to take advantage of all the opportunity that's going to be out there for us in the coming years? There's opportunity every day in this country, don't get me wrong. But right now we're at peak bubbles. The market's gone crazy for over a decade now. Real estate, the stock market, the Fed's kept rates at basically zero, has pumped trillions of dollars into the economy. So if you look at the long-term yield, the long-term curve, the short-term curve, and everything's starting to collide right now. These cycles that we go through history, everything is kind of at this what's the word? But at the top right now. And so it's going to come back. It's going to pull back. We're going to see some changes happening. And this is the opportunity that I'm talking about. So now's the time to be prepared for it. And one of the reasons why I really want to stress this is, I was in over on the other coast of Florida this weekend. So I live over in Jupiter, Florida, on the east coast of Florida, but I was over on the west coast of Florida in Fort Myers, Florida, and I have some family that lives over there. My brother and his family, and some of our other family live over there. And we had a big family get together for some of the kids' birthdays. And so we were talking on Sunday afternoon out by the pool, hanging out and, just talking about what I do and how we create banks for people and private money lending and keeping money moving and things like that. And I understood that, my family's pretty smart when it comes to, they're successful in what they do, and they're smart people. But when I really started talking about what I teach and what I do, they were like, started asking me all these questions. It was things that I just kind of assumed that they already understood or they already knew. So we started kind of like really taking it down to the basic level. And I started just kind of explaining it in a way where, hey, anybody can do this. And by the end of the conversation, they were like, wow, that makes a whole lot of sense. Like, why haven't we already talked to you about this? And why haven't we already, started doing things with you to have you help us get this stuff going for ourselves and our families? And so when I talked with them this weekend, I just made me think like, I sometimes take for granted a lot of the stuff that I say and a lot of things that I presume other people, because I do this all day, every day. This is all I do 7 days a week for over the last 14 years of my life, is talk money, talk investing, talk real estate, talk banking, and things like this. So, I got to realize that not every other people have other careers and other things that they're doing. So I just wanted to kind of lay that out there. So what I'm going to do with you right now is kind of just take it down to this basic level and show you how easy this is for anybody to stop implementing and how powerful it can be for your family's financial future. And before I get there, I just wanted to thank a couple people. So this is Brent Kessler. Brent Kessler is the founder and CEO of the Money Multiplier. So I told you I was going to give you some different resources, some different things to check out here tonight. So write this one down. Write down Brent Kessler and write down themoneymultiplier.com. Awesome guy. And then if you're here right now, you probably know Chris Noggle. Chris is another amazing guy when it comes to business and money and just who he is as a human being. And, both of these guys I consider my mentors, my friends, my business associates, partners, but just unbelievable human beings. And so, over the last several years, I found, your network really does equal your net worth. If you look around at, the 5 to 10 people you surround yourself with regularly and you hang out with and you converse with regularly, you start to get on their level. And if you converse with people and hang with and become friends with people at levels that are way up here, or if you do it with people that are way down here, you're going to tend to drift either up or down along with the tides. And both of these guys, their mantra, their life saying is, if we can create enough change and we can teach enough people, it's going to raise the tides for everybody. And those are the kind of people you really want to surround yourself with. So, we do masterminds together. We do trainings together all the time. If you ever have an opportunity to come to one of our events, make sure you do so, because you're going to meet people like Chris, like myself, like Brent, and this is who you want to surround yourself with. It's just so very important, because Will Rogers, I think, says it best. And this is a quote I love. The problem in America isn't so much what people don't know, it's what people think they know that just ain't so. So if you think about that for just a second, we're told our whole lives to do things one way. We're told our whole lives to, invest in a 401k or climb the corporate ladder or go and get a job and play it safe and do what you're told to do and all this stuff. And, over time, the markets are always going to go up. And if you're smart with your money, you'll eventually be able to retire. Well, it just ain't that way, and I've seen it personally firsthand as a financial advisor, and over the years of working with people that are looking at their finances and learning investing and trying to make something better of their lives through these different types of strategies. So I've seen it firsthand. But who else tells us that this system of doing what everybody else tells us to do just doesn't work? Is the Social Security Administration. In fact, the Social Security Administration tells us if we take 100 people in this country today, that only 5 out of 100 are going to be able to retire the way and the lifestyle that they want to retire at. Meaning 95% of Americans in this country, in the richest country the world's ever known, with more opportunity than ever's been out there in the history of the globe, of the world. Right now, this is the times that we live in, right? So how are 95% of people that work their entire lives not able to retire and enjoy retirement the way that they want to? And to me, that's a problem. It's a big problem. And it's one of the things that drove me away from being a financial advisor, because I would talk with people and they'd tell me all about their dreams and their goals and everything they want to accomplish in life. And then I'd have to bring them down to reality and say, okay, I love those dreams and goals and you can get there, but you're going to have to change some stuff. You're either going to have to save more money now, meaning you're going to have to stop spending as much and change your lifestyle now, or you're going to have to take on more risk, and you're going to have to be more risky with your investments, which doesn't always pan out right, or you're going to have to push back retirement. So instead of this dream of retiring at 60, 62, 65, you're not going to be able to retire to be till you're 70, 75, 80 years old. You're going to have to continue to work or completely change what that lifestyle looks like in retirement for you. So to me, somebody works their whole lives and not being able to retire, it's a shame. So my question to you is, are you committed to becoming the 5%? And what if I told you that to become the 5%, you don't have to work any harder, you don't have to work any longer, and you don't have to take on any more risk? We're just going to change one or two little things in your financial life. For example, what I'm teaching you right now today, where your money goes first. Become your own bank. Stop making the banks rich and make yourself and your family rich and create that legacy. So if I told you could become the 5% by implementing this one strategy, would you be okay with that? Are you willing to listen? And if so, then stick with me, because that's exactly what I'm going to do with you right now as we get rolling through this. So before I get there, let me just ask this question. Why aren't more people successful? Why is money a mystery? What do you think? Put it in the chat box. I mean, what holds people back from reaching their goals? Why are 95% of Americans in this country not able to retire the lifestyle that they want? What do you think? Put it in the chat box. I'm just curious what other people think. When it comes to the mysteries of money, while you're putting that in there, money's not a mystery. Money's easy. You guys know what money is? Money is simply a means of exchange. So it could be a dollar, it could be crypto, it could be these cool sunglasses I got right here, right? Ooh, what do you guys think? The special money multiplier edition. Money can be whatever it is. If somebody right now is willing to trade me these glasses for a book, trade me these glasses for whatever, that's money, right? Means of exchange. So that's all money is. And once we realize that, it's okay to talk about money. It's okay to talk about what you're investing in. Talk to your friends and family about money and investing. Once we realize it's okay and it's nothing special, then that's going to drive us that much better. So let's do that, right? But let me see what people, so lack of financial education, Kevin said, absolutely. Katie, they don't understand how money works. So, yeah, definitely. Unit of choice is money. Yeah. Yeah. I mean, at the end of the day, money is freedom, but yeah, I mean, it's just a means of exchange. Madeline, status quo, fear, lack of knowledge about money. Yeah, absolutely. Those are all things that I've found with my experience have held people back. So taxes, inflation, and volatility. These are what we call wealth killers, these top three right here. So these wealth killers, I mean, I think we all understand taxes and how they just drain everything that we make. So let's start implementing little strategies like starting a side business in an LLC where we can start writing things off to lower our tax burden. Let's start being smart with our taxes. If we're making good money and we're a high net worth individual, let's start looking at things like 1041 tax strategies using complex trusts and charitable foundations to lower our tax burden. I mean, Warren Buffett said it best, right? Warren Buffett said, it's amazing that in this country, I'm able to pay less in taxes than my secretary. In fact, one of my tax mentors, he says there's two tax laws in this country, one for the informed and one for the uninformed. Both are legal. So if we have this tax code book that's this big, it's this big for a reason. Why? Because the wealthy, they understand how to take advantage of it and pay less. So there's little things that I can teach you to start eliminating taxes. One of the things I'm showing you right now today is how to put your money into a vehicle that's going to grow tax-free for the rest of your life. And then that amount of money, multiples, will be paid out to your beneficiaries, your kids, grandkids, whoever, your loved ones, completely tax-free as well. So we're going to start eliminating taxes. How about inflation? You guys know what inflation is. Inflation's easy. It's all over the news right now. Inflation's been running very, very hot. It was 9.1% last month. We're sitting at 8.5% year over year right now as we sit here on August 16th, 2022. Inflation's running crazy. What that means is what you could buy for $1 today is worth 8.5% less than it was last year at the same time. So it's the degrading, it's the devaluing of the dollar is what inflation is. So the best way to beat inflation, keep your money moving, keep your money in vehicles that are constantly compounding and growing, and then keep that money making more money for you. So I'll show you that here today as well. And then volatility. this is one that I always think is crazy because one of the arguments over a 401k, for example, is a 401k, you're putting all your money into the stock market, right? You're investing in funds or lifestyle funds or whatever they are. So you put your money in there. And the idea is that over time, the stock market has always gone up. If you look at any 10-year time span, for instance. But let me ask this question. How many people in 2007 were on that upward trajectory? And then in 2008, everything crashed, but they wanted to retire in 2009. Were they able to retire? Absolutely not. Why? Because they were riding that thing up, but then when they needed the money, their money fell in half. I mean, it happened to a lot of people this year. I think the S&P, the Dow's down something like 20, 25%, and that's just getting started. That's going to continue to drop. So if you're young, sure, let me put my money in there and let it ride over time and hope that, but if you need the money right now, volatility can kill you. So we want to be consistent. We want to be predictable with our income, especially when we start to approach retirement age. And putting it into more conservative stuff when you get closer, you could still lose, because what's a conservative investment in the stock market? 3-4%. Well, if inflation's running at 9%, you're still losing money. So there's a lot of challenges here when it comes to volatility, and it's a lot more to it than just what people make it sound easy to avoid. So what I do is I put my money into guaranteed vehicles with growth. I move my money depending on what the markets are doing, where I can create consistent, predictable income for my investments. So this is stuff I'll show you here right now as well. And then these last three are going to be up to you. Following the status quo. We talked a little bit about that a second ago, right? What people in America think they know that just ain't so. And then fear in life. So fear, fear of doing something new, fear of going against what everybody else has told you to do, fear of, investing. But you know how fear is overcome? Fear is overcome with education, with support. And that's why I do 6 live webinars every single week. That's why we do training events and masterminds all the time. That's why I continue to go to masterminds, other people's events, and network and learn and hire mentors to teach me to overcome my fears. Because when I want to go to the next level, I need somebody that's going to help me get me there. And just like I'm going to do for all of you on here right now, I'm going to eliminate any fear you have. And I do that through education and support and helping you do so. So from this point moving forward, my commitment to you is I will always be there to you to help you, support you, answer your questions, and make sure that that fear is out of your life, at least when it comes to finances, investing, and money. Okay, fair enough. And then life at the bottom right there. Yeah, shit happens. Divorces, deaths, pandemics. Like, we can't predict what life throws our way, right? People lose their jobs for unknown reasons, like for whatever reasons. Like so life is one of those kind of things that we can't always predict, but can we plan for that stuff to happen? Let me ask you this question. When COVID hit and shut down the country and nobody could go to work or do anything at all, right? How many of you were panicking because you had one income stream? Well, guess what? When COVID hit and shut everything down for me, I was like, all right, well, let me just pivot and do something different. It didn't matter. Why? Because I have several income streams feeding my finances that allow me to stay afloat until I got my main primary income stream going again, to where I could continue to do what I was doing. But those additional smaller income streams will keep you going when the unexpected happens. Things like death, things like divorce, all this stuff, we can plan for it because death's inevitable. Maybe a death that we weren't, someone young, and it's a tragedy, but it doesn't have to be, because it can be sad, but financially, it doesn't have to be a tragedy. Does that make sense? So there's things that we could do to start preparing and make this happen. So that's all I'm saying right there, is we don't want to look at these as excuses anymore, because they're not excuses. These are things that we can overcome very, very easily. All we need to do is learn a little bit and have somebody that's willing to teach you and help you do so. And that's what I'm here for, every single one of you. So this is a great example on mindset. Go write this down. The backwards bicycle. When we get off here tonight, go on YouTube and type in the backwards bicycle and watch this video. It's like 8 minutes long. It'll blow your mind, because it just goes to show you how when you're told something, you learn something your whole life, and you make one little change, it's very difficult for your mind to wrap around that change. And this video is a great example of that right there. So go check that video out and then relate it back to everything you're learning with me right now today. A couple books real fast. Robert Kiyosaki. I'm big on mindset. If you guys can't tell, I'm big on mentors, coaching, training. So these are some books that are really good when it comes to this concept. Anything Robert Kiyosaki does. You guys like Rich Dad Poor Dad? Anybody read those books? Love it, right? I love Kiyosaki, everything he's done. I actually got to teach and train with him years ago. And his ghostwriter, Sharon Lecter, on the Rich Dad Poor Dad series, awesome lady, was hanging out with her just a few months ago, actually. But really good book right there. Tony Robbins, Money Master of the Game, talks all about the infinite banking concept in this book right here. Check that out. This is the Bible. You guys got to get this book if you don't have it already. Becoming Your Own Banker by R. Nelson Nash. And then Anything by R. Nelson Nash. He's the godfather. This is like the godfather of the infinite banking concept. What I'm teaching you here right now has been used for over 200 years. This is nothing new. It's not something I invented. R. Nelson Nash started to bring it to the limelight, and now I'm just bringing it. Chris, myself, Brent, we're just bringing it to the next level. So that's kind of the progression of what this infinite banking concept's done. But a lot of what we teach and do is based around what Nash teaches in that book right there, Becoming Your Own Banker. So go get it. Mapping Out the Millionaire Mystery. This is an updated version that Brent and Chris wrote of Becoming Your Own Banker. And actually the Private Money Guide, you guys are going to want that book too, because it's all about money, moving money, predictable, consistent income, and how to be very, very smart with your investing. So those bottom two books, actually, for everybody that's on here right now, I'm going to give you guys those free of charge. Do you like that? You want those free? So what you need to do, let me see if I have this on here. Okay, here's what you got to do. If you guys want those books free of charge, here's what you're going to want to do. Go to this website right here, moneyschoolrei.com. I'll put it in the chat box. moneyschoolrei.com/Snaggy. Go to that site, put in your name, email, and phone, and you it'll automatically email you or give you a link for both of those books so you can download them digitally right away. And then if you want physical copies, we'll actually give it to you for free as well. You just got to pay shipping if you want the physical copies. But I'll send you immediately those digital copies of both those books just for being on this webinar right now, okay? So go ahead and go check that out. Like I said before, my name is Stephen Nagy. I've been doing this for about 15 years now, former financial advisor, fully licensed, Series 766, 215 variable annuity. I no longer have those licenses. I let them go after a couple of years when I looked at myself and I said, I'm never going to go back to traditional advising. Like once you learn entrepreneurship, once you learn about real estate investing, once you learn about alternative investments and everything that millionaires do, that banks do, you're never going to go back to the old way. I can promise you that. I let all that hard work go, and I don't regret it one bit. I never regret doing that. And I've always just moved forward, and it's worked out pretty well. So this is my family, my wife, Courtney, my son, Bryce. And by the way, guys, I'm happy. I'm an open book. Like if anybody wants to know more about me or has any questions personally, professionally, when we talk on the phone, ask me. You know, I don't like to spend a lot of time on these talking about myself. So let's get into this. All right. So a couple principles that I'm going to teach you tonight. First off, simple versus compound interest. And then I'm going to teach you a little bit about what's called spreads. And then we're going to talk about moving money and how all of this works. But this is a really great example of simple versus compounding interest. And I usually tell a story about buying a car and all this stuff, but I just want you guys to get the basics of this. So, can you make money earning 4% while paying 6%? It sounds silly, like the first time I saw this, I was like, well, no, duh. Like if I'm paying 6%, there's no way I'm going to make money on 4%. But we got to understand how money works, right? Because check this out. When you get a car note, let's say you get a car note for $25,000. And let's say that car note's at 6%. So you're thinking to yourself, all right, if I have $25,000 and I'm paying 6% over 5 years, I'm gonna pay a lot less, right? So here's where this comes in. And then if I have money over here at 25% earning 4% over the same 5 years, well, I would think to myself, well, I would end up, this 25 would become a larger number over the same 60 months because this is 6% and this is 4%. But look what happens here. This $25,000 ends up becoming $29,000. This $25,000 at 4% ends up becoming over $30,525. So you actually have over a $1,500 increase on the 4% side and the 6% side. And the reason that this happens is because a car note is simple interest on a depreciating balance. Okay. This principal, $25,000 that you start with, every time you make a monthly payment decreases. And the way simple interest works is you're paying the 6% over the 5 years on the balance, not on the total $25,000. So over time, that amount's going to decrease. Now over here, this $25,000, this money is sitting in this account for 60 months, compounding. So each year that that money compounds, the amount is higher. And then that higher amount each year compounds at that higher level. So the 25,000 the first year, the second year might be 26,000. The third year might be 27,500. The fourth year might be 27 or 29,000. And then the fifth year, 30,500. So each year the amount becomes more, and it becomes more exponentially. So each year, this growth on this, if I was to show you over 120 months, it would be a much bigger number, not just another 5,500. It would be a much bigger number, because now the 4% starts compounding at 30,500, and then even more each year. Where over here, we put that 6% depreciating balance down all the way down to zero. Can you make money earning 4% while paying 6% all day, every day? In this example right here, we made $1,500 over 5 years. Does that make sense to everybody? Is that basic? Those of you who have seen this before, is it easier for you to understand that example, or walking into the bank and getting with the bank teller and them offering you a note and all that stuff? Just put in the chat box if you've seen this before. I'm just curious which example you like better. All right, I just wanted to make sure that made sense right there, the compounding interest. So you guys following? So what is the money multiplier method? Let's dive into this, all right? So the money multiplier method is really going to consist of 3 parts. So we have the machine, we have the marathon, and we have the millionaire. So the machine is going to be the vehicle used for, it's basically the account used for where we're going to put all of our money into, okay? So that's what the machine is. And then the machine's going to do a bunch of really cool stuff for you. I'll show you in 2 seconds. The marathon is the fact that this takes a little bit of time to get rolling. Now, the money that you're putting into this account, you're immediately going to be able to use it, and it's immediately going to start compounding and being advantageous to you right away. But for the millionaire, third part of this, the millionaire, it is going to take a marathon, okay? It's going to take a little bit of time. If I can show you how to literally take on no more risk, work no harder, work no longer, but be able to achieve the goals that you want to achieve, are you okay with a marathon? If it gets you to your end goal easier? I hope so. And that's what this is for, okay? That's what we do with this, is we use this machine, and then we follow this process. We follow this method to become the millionaire. It's that easy, okay? And that's what I'm going to show you right now. So what is the machine? The machine is a whole life insurance policy from a dividend-paying, mutually owned insurance company, all right? So why is the machine a whole life insurance policy? Well, there's a couple reasons. First off, it's the only account, it's the only vehicle that gives us all of the benefits that this gives us. So what are those benefits? Well, it allows us to flow our money into this whole life policy, into this account, and every dollar that goes into there is going to compound, guaranteed, uninterrupted for the rest of your life, tax-free. Let me repeat one more time. Why do we use a whole life insurance policy? Because every dollar that you put into this is going to compound, uninterrupted, guaranteed, tax-free for the rest of your life. You okay with that? That's it. Now, let me be very clear. This is not a whole life policy that your friend, your brother-in-law, somebody from high school, somebody in your networking group, policygenius.com, insurance companies direct. This is not a whole life policy that they would create for you. This is a very specially designed and engineered whole life policy built for banking, built for this concept, period, okay? I am one of less than 1% of insurance agents in this country that design and build policies like this. And this is all me and my team do all day, every day, okay? So if this makes sense to you tonight, I just want to be very, very clear. You're going to come to me and my team to get this started for you. You're not going to be able to just call somebody randomly and do this. You can try. and then call me, and then I'll set it up properly for you. And it does need to be set up properly because there's a lot of rules and regulations involved with this, okay? So that's where I come in and my team come in. The government, the IRS, gives us this ability using these policies, and I'll explain why in just a second. So again, why do we use the whole life policy? Because we have that uninterrupted compounding growth within it there, tax-free, guaranteed for the rest of our lives. Albert Einstein said this about compounding interest. It's the eighth wonder of the world. Those who understand it use it, those who don't pay it. And when it comes to creating wealth, there's two laws. That's law number one. Law number two, money movement. So remember this, money sitting still is losing money. Remember we talked about inflation and things earlier? Money in motion is making more money. So we always want our money out there moving and making more money for us. Fair enough? So why do we use a whole life policy? Because every dollar we put in there not only takes advantage of law number one, uninterrupted compounding interest, keeps that money moving, but keeps that money compounding. But number two, simultaneously, that money that we're putting into this policy, I can simultaneously pull it out and keep that money in motion and keep that money moving and making more money for me. And even when I pull that money out, my money's still in there compounding and growing for me uninterrupted for the rest of my life. So it allows me to take advantage of both laws for creating growing wealth simultaneously at the same time. So that's why we use whole life insurance policies. It's the only vehicle that allows us to do all of that in this country. So why do we use it? Who else does it? Well, there's two groups of people that use whole life this way that are pretty good when it comes to money. So the first group are banks. Okay, this is something called bank-owned life insurance, BOLI. So write this down. I want you guys to check this out later on. Go to Google and type in BOLI, bank-owned life insurance. Banks, M1 money supply. Over 90% of all of banks' money goes to two places. Do you know where? Number one, whole life insurance. Banks are the largest purchasers of whole life insurance in the country. If you ever walked into a bank and why everybody is a vice president of the bank, it's because them being a vice president gives the bank an insurable interest on that individual, and they can buy whole life policies on those people. Do banks know how to make money? Absolutely. So if banks are doing this, do you think maybe we should do it too? Why not? Number two reason, place that banks put their money, real estate. So I'm going to talk to you a little bit about real estate later on, but real estate and private money lending specifically is one of my favorite ways to keep money moving and making more money for myself. So if banks are doing whole life and banks are buying real estate, do you think maybe we should do the same? Why not, right? So who else uses whole life in their everyday lives in history? Well, Jim Harbaugh. How about Jim Harbaugh, football coach of the Michigan Wolverines? Check this out. This was from, I forget which news publications, but this was back in 2016. Cash value life insurance makes Harbaugh college football's top paid coach. This type of deferred compensation alternative appeals to talented leaders and executives. And it just talks a little bit about how they've used whole life insurance to create deferred comp to make him the highest paid coach. Joe Biden, President of the United States of America, it talks right here. In addition, Joe holds 6 life insurance policies with Mass Mutual. One of the companies, that's Mass Mutual, is one of the mutually owned insurance companies that we do business with. And one of the things that I'll mention right here is it talks about the 6 whole life policies he has, but that's it. Whole life is also protected. It's private. It's a lot of times excluded from bankruptcies and lawsuits and judgments in most all states. So it's very private and protected. Is that important? Yeah, for a lot of people, especially people like Joe Biden. Walt Disney, check this out. Walt Disney wanted to start Disneyland after failing his pursuit of traditional means of financing. A large part, Walt decided to provide his own financing. A large part of this came to be by collaterally borrowing money from his cash value life insurance. Pampered Chef, Doris Christopher, borrowed from a life insurance policy to start the Pampered Chef. Years later, it was acquired by Warren Buffett for $1.5 billion. Ray Kroc, partnered with the McDonald brothers and opened McDonald's in 1955 and 61. He bought the brothers out. Croc did not take a salary for 8 years, and to help with cash flow, he borrowed money from his 2 cash value life insurance policies to help cover salaries of key employees. Who else has used this over time? People like the JPs, Morgans, Chases, Vanderbilts, Rockefellers. The list goes on and on and on. Like I said, this is nothing new. Using whole life this way, using the infinite banking concept's been around for a very long time. This is just something that we've brought to the limelight and is very, very powerful that anybody can go out there and do. All right, so let's talk a little bit about the banks for just a second. And this is going to start talking about spread. This is very important when it comes to this concept. So how does spread work? Spread is very easy. Spread is nothing more than you going down to the bank, depositing $100,000 in your bank account, the bank paying you 4% in a savings account. The numbers are irrelevant. Just follow me here. So the bank pays you 4% in a savings account. What does the bank do with that money? They don't let it sit there, right? They immediately start moving that money. So the bank is looking for people to lend to. So the bank they're paying you 4%, and then they go and they give somebody a home loan at, say, 7%, right? So if they're paying you 4% and they're making 7%, that's what's called a 3% spread. So what you're paying versus what you're earning, the difference is the spread. So just keep that in mind as we go, because a lot of what we do is going to be based on spread, okay? And we could go on and on with this example, 4%, but this is what banks do. They take your money and they immediately move that money to make more money. And then check this out. At the end of the day, this is why we need to become our own bank. We need to stop making the banks rich, because the banks at the end of the day, they're paying us 4% on the money that we keep there. Well, they're making, if I add up all these spreads, they're making lending all my money out. They just made 20% of my money. Or actually, if you do the math, 20% is 5 times more than the 4% they're paying me. So they're making 500% on every dollar that I leave at the bank. So every time I go to the bank and deposit money in my checking account, my savings account, the bank is making, actually it's more than that. And don't take my word for this, guys. Go, more homework for you. Go to BauerFinancial.com. Bauer Financial is a company, is a research agency, actually. And all they do is research on banks and their financials. And Bauer Financial tells us banks make between 400 and 1,300% on money that you leave there. So let me ask you this question, knowing that. If you owned a restaurant and you have family in town and you wanted to take them out to eat, where would you take them? Probably your own restaurant, right? Or if you had, if you owned a hair salon and you got to get your hair cut, right? Where would you go to get your hair cut? Probably your own hair salon. Or if you owned a gym, right? Where would you work out? Well, let me ask you this question then. If you owned your own bank, where would you do all your banking? At your own bank, right? Obviously. So why haven't you set up your own bank yet? It's kind of a rhetorical question. Probably nobody's taught you this stuff, right? Knowing especially that the banks are making 400 to 1,300% off money that you park there. Why are you making the banks rich? Let's keep that money in our financial lives. Let's keep that money in for us and our families. Are you okay with that? So let me show you how to do that. So let's take a dollar bill. Let me show you how to start recapturing all this money you're giving to everybody else right now. So let's take a dollar bill. On average in this country, every dollar that you make, 20 cents of that is going to go to an automobile, whether it's a car payment, whether it's interest, whether it's not interest, whether it's gas, upkeep, maintenance, whatever, right? Out of every dollar you make, 30 cents of that dollar goes towards housing. Out of every dollar you make, 40 cents goes to everything else, food, travel, kids, whatever, which leaves us with 10 cents. And this is what most people do. They get a paycheck, they put it into the bank, and then they start paying their car bill. They pay their mortgage or rent. They pay all their other bills, Netflix and cell phones and insurance and everything else that goes out the door, right? And then whatever's left over, we might be lucky if we have 10 cents left over of that dollar that we earn. So how about this? Why don't we start paying ourselves first? Why is everybody else so much more important than ourselves are? So number one, why don't you commit not only to let me help you and start teaching you this stuff and implementing it into your lives, but why don't you also commit to paying yourselves first? Are you important? Absolutely. So let's pay ourselves first. So let's just look like what that would look like. If we were to pay ourselves first and keep all this money within our family, how much more can we save? So check this out. So let's start with the 10 cents to ourselves. But now we got the automobile payment, right? So follow me. Out of every 20 cents of every dollar we make that goes to an automobile, 5 cents of that 20 cents goes towards interest. Okay, 5 cents goes towards interest. So instead of giving that interest to somebody else's bank, we're putting the money in our bank. So let's now pay ourselves that interest. Are you okay with that? So by doing that one step right there, we just increased our annual savings by how much? By 50%. Think about it. If we were saving 10 cents before and now we're saving 15 cents, that is a 50% increase in our annual savings. That one thing right there. What else can we do it with? How about our mortgage? Did you know mortgages, rental properties, or maybe whatever? Did you know in this country, 25 cents of every 30 cents that's spent on housing goes towards interest? How is that possible? How is 25 of every 30 cents going towards interest? Well, the banks have this stuff figured out. On average in this country, every 7 years, somebody is going to either move or refinance. Either way, they're starting a new mortgage. If you refinance, you're starting it all over again, right? If you move, there's a pesky little paragraph called the due on sale clause in your mortgage. That due on sale clause requires you, when you sell that house, for the new person and when you move, to get a whole new mortgage. You can't just transfer that mortgage with you. Why do they do that? Because on average in this country, somebody moves and refinances every 7 years. And guess what else? Over 90% of all interest on a 30-year mortgage is paid in the first 7 years. So over 90% of the interest is paid in the first 7 years. And then you're moving and refinancing every 7 years. Do you see where I'm going with this? So all that interest on average is going to someone else's bank. So let's recapture that money back to our bank. You okay with that? And then of the 40 cents, on average, 5 cents of that goes to interest. So while we're at it, why not recapture that 5 cents as well? So we just increased our savings by doing nothing else except where our money goes first, into our bank instead of somebody else's bank. We just increased our savings from 10 cents to 45 cents a year, 10% to 45% a year, not working any harder, not working any longer, not taking on any more risk. You okay with all this so far? All right, let's keep going. So I want to get more specific. So how would you like to get all the money back for every car you'll ever buy, drive, and own in the future? What do you think? But before I do, let's take a quick little look under the hood of one of these whole life insurance policies. So this is the machine. Remember, this whole life machine, this whole life policy is the machine. So let's take a little look under the hood. So right over here on the right is what we call an illustration. And this illustration shows what the policy is going to do over time, okay? So a couple things to point out here. This is the policy year. This is the age of the individual. This was a 26-year-old male, just so you know. Deposits. What are deposits? Well, the deposits are actually the premiums. So when we build one of these full life policies, you're going to tell me how much you want to deposit into this thing on an annual basis. Now, you could pay into it monthly, quarterly, biannually, or all up front each year. You can put those premium deposits in, but you're going to tell me how much. And by the way, how much you put into this thing is up to you. Like, I'll never tell you how much. We're going to recommend 10 times your age on a monthly basis or more. So if you're 30 years old, 300 a month. If you're 50 years old, 500 a month. So that amount or more would be good for like a first policy as like a guideline minimum to get started. But you're going to tell me how much you want to put into this thing. So this guy wanted to put $10,000 a year into it. But the reason I call these deposits is because of a little bit of mindset, right? Think about it. A premium, we think of like a negative, like a bill, like, oh, I got to go pay my premium, or I got to go pay this bill, right? But what about a deposit? You get a $5,000 check, a $5,000 check from a wholesale deal, or you cash something out and you make a nice profit on it, or you even get your paycheck, whatever, right? You get excited to go down to the bank and deposit that money into your bank account. Well, are you okay with now being excited to go deposit that money into your own bank? So from this point forward, another commitment I want from you, I want you to commit to not calling these premiums anymore. These are now deposits going into your new bank, going into your new whole life policy. Fair enough? All right. So over here, the cash value in the money multiplier account. So this is what's available to pull out of the policy as the money goes in and as the money compounds and grows for you. This is what is available to take out to use. Because remember, we have the compounding growth, and we also are able to use the money as we go. Okay. And then, of course, we have the death benefit. Now, we don't really talk about the death benefit, but it is a nice little added bonus on there as well. And the death benefit does increase for the rest of your life as well. And again, that death benefit does get paid out tax-free. But when we build a policy, you tell me how much you're going to put into it, and then that's what determines the death benefit. And age doesn't matter. We do these policies for babies, teenagers, 20s, 30s, 50s, 60s, 70s. Doesn't matter. And if you're older, if you're 80 years old, or you're just in terrible health and you can't qualify for a whole life policy, don't worry. You can still own it. You can still bank with it. You can still control every aspect of it. We'll just put it on someone else's life. Fair enough? All right. So that's a quick little look under the hood. Now let's start recapturing this money for these cars. So this is that same policy, using this as an example. So he starts putting money into this thing. In the third year, he wants to buy a $25,000 car. So we take the money out of that cash value that's in the money multiplier policy in the account, and we reduce the cash value to buy that car. But then if you buy a car, you're going to want to pay the car loan, right? Because when we take the money out, it comes out for. So if you go to the bank and you get a car note, would you pay back that bank? Absolutely, right? So if we get on our bank and take a loan to buy a car, are you okay with paying your own bank back as well? Absolutely, right? So that's how this concept starts to work. We put the money in, let it compound and grow. We take the money out, do what we want with it, and then we recapture it back. The biggest difference, though, however, is our money's now compounding, and also all that interest we were paying to the bank, we now pay to who? Ourselves. So now we're recapturing that money back to ourselves. So for over the next 5 years, 5-year car note, we pay ourselves back. So we put $70,000 into our new bank policy. We took $25,000 out to buy a car. We recaptured $30,000 back in for a total of $75,000 that we put into the policy. Now you can see right here, however, we have $67,000 sitting in our account. And we have the $25,000 car sitting there in the driveway. So I haven't recaptured all of the money, 91% of it. So not bad. But we do have a $25,000 car sitting there, free and clear, paid for. But I did tell you I'd show you how to recapture all the money for the cars you'll buy, drive, and own. So let me show you, because this doesn't stop after 7 years. This is going to keep going. Now, for the sake of this example, I didn't want to put any more money in because I wanted to show you how this thing is going to compound and grow on its own. But in reality, you're going to want to continue depositing money into your bank. Why would you not? And if you don't, just ask me and I'll show you how we can turn the spigot off. But for this example, we put no more money into this policy. We buy another car in year 8 for $25,000. We pay ourselves back. We recapture the money. So total, we put $30,000 more into it. We took $25,000 out. So look over here. We started in year 7 with $67,000. We finished 5 years later, $91,000. That policy grew by over $23,000. All we did was put $5,000 into it. We put no new deposits into it. We now have 2 vehicles sitting on our driveway worth $50,000, and we have $91,000 in our policy waiting for the next use. I would say we've recaptured all of the money for both of those vehicles, having them sitting there in our lives, and we have $91,000 ready to deploy for the next use. So 3 rules to make this happen. I told you rule number 1 earlier. What is rule number 1? Pay yourself first. Rule number 2, pay yourself with interest. Again, if you're going to pay someone else's bank interest, pay your bank back with interest as well. And rule number 3, always recapture and recycle that money, okay? Let me show you those 3 rules right now. Pay yourself first, pay yourself with interest, and recycle and recapture that money. Now, here's one difference in paying your bank for somebody else's bank on this card note, other than you get all that interest back to yourself. But here's a big one. If I buy a new car right now and in 3 years from now, something happens financially and I can no longer afford that car, so I stop making the car payments, what's going to happen to that car? Well, I'm going to look out the window one day and some guy with a big beard is going to be probably a little bit bigger guy, right? With a big old beard is going to stop out of a big truck and he's going to go and he's going to hook up a bunch of chains to it and he's going to tow that thing away, right? The repo guy, because I stopped making my car payment. But if I stop making my car payment back to my bank, what's going to happen? Nothing. You're in complete control. When you take the loans from this policy, when you use that money to buy a car, when you use that money for anything you want to use it for, there's no terms. You set the terms. The insurance company doesn't care. So how, when, or even if you ever repay that loan is completely up to you. Now, to follow the infinite banking concept, you're going to follow these 3 rules and always recycle and recapture that money back in, but you don't have to. So if you run into some financial hardship a few years down the road, just change the terms. Start making the repayments when you can. It doesn't matter. You're in charge. You're in full control. And if this works for a car, what else? What other kind of major purchases? Rehab on the house, a pool, a boat, an airplane. You tell me. So this is very important. Let's pivot for just a second. Let's pivot over to debts, okay? Does anybody have debts? Any debts on here? Let me show you how to start paying off debt while continuing to build wealth, recapture all that interest back into your life, and do it a lot quicker than otherwise possible. So this is another real case study. This was a chiropractor that got himself in $478,000 in debt. He was paying out $5,700 a month, a total of almost $70,000 a year in third-party debt. And this was the breakdown of all of it. We did the math. If he was to continue to pay this debt as planned, it would take him 19 years to pay all this debt off. So we said, all right, let us show you how to do this using the infinite banking concept while a lot quicker, while continuing to build wealth for the future. So this chiropractor told us that he wanted to start a policy putting $25,000 a year into it. Remember, you tell me how much you want to fund this policy with. When this chiropractor put $25,000 in, he had $15,000 he could borrow back out to use. Okay. And the reason why that is guys, just so you know, you don't get access to 100% of the money immediately. It takes a few years, but once you start getting access to 100%, it never stops. You get more and more and more exponentially so. But in the first few years, you're going to be a little bit less. Now, I can build a policy for you, higher cash value. When you put 25 in, if you want closer to like 22,000, we can do that now with these new policies, very high cash value. But for the sake of argument, I left this case study and example the way it is, because this still works very powerfully so, even with a policy that's not as high a cash value in the first year. But just know I can't do that now. So if you are looking for that, just let me know. So what do? We put 25 in, we pull $15,000 out, then we pay off the Discover card, the Lowe's card, we pay down the Nordstrom card. So now what are we going to do? Well, that $448 a month that was going to Discover and Lowe's, we no longer are paying to Discover and Lowe's. So what are we going to do with that money now? Yeah, rule number 3, right? We're going to recycle and recapture that money back into our banking system. All right. So that $448 a month, we're now going to stop paying to Discover and Lowe's, and we're going to start paying that back to my own banking system. So one of the things that we're going to teach you to do as you get started with this is we're going to teach you how to open up what's called a segregated bank account, also known as a separate bank account. So this is just a separate checking account that when we take money from the policy, it goes into this separate checking account. From there, it goes to pay off the debt or use it for whatever you're using it for. And then when we recycle and recapture it back in, it goes back into this segregated account where it can be used to go to the next deployment, to pay off the next debt, or we can cycle it back into the policy once we're ready, okay? So that $448 a month, instead of Discover and Lowe's, is now going to go back into my segregated account, my banking system, okay? And you'll see where that goes in just a second. So year 2 of this policy, $25,000 goes in. Now our cash value available is $16,500. Remember last year, it was less than 15. You can see how it's going to be more and more every year for the rest of your life. And then we have the 5374. What are these payments? Well, this is the 448 a month going into our segregated account over the year, grew to be 5374. So we now have $22,000 we can deploy to pay off more debt. So bye-bye Nordstrom, bye-bye Wells Fargo, bye-bye private loan, and reduce the BMW payment. Same thing. That $19.17 a month that was going to everybody else is now going back to my banking system, and $38.60 is going to third-party debtors. Year 3, same thing. You can see cash value in year 3, all the recycled and recaptured payments from last year, total of $48,000. Bye-bye BMW, bye-bye West Marine, lower the balance on the condo, $36.77 going back to me, $2,100 going to third-party debtors. Now, before I go on to show you the rest of this, let me make sure you're following so far. So far, how much have we put into this thing? $75,000. How much do we take out of this thing? $55,000. So how much do we have left in the policy? We took 75 out, or we put 75 in, we took 55 out. How much is left in the policy itself? $20,000? That's what you would think, right? Nope. If you've been paying attention, you still have the full $75,000 sitting in there. Why? Because when we take the money out of the policy, it comes out in the form of a loan. We collateralize essentially our policy, and we borrow money from the insurance company's general account, and that allows all of our money at all times to remain in there doing what? Compounding, uninterrupted, tax-free for the rest of our lives, even while we're simultaneously using that money for other things. So let's keep going. Year 4, $25,000 goes in, $26,000 available, $44,000 in recapture payments from last year. We now have $70,000, reduce the condo. Year 5, 25 goes in, 27, 44, 71, bye-bye condo. All right, year 6, here we go. Now follow me on this one. In year 6 of this policy, this chiropractor could no longer put $25,000 a year in. He was limited to $10,000 a year from that point forward. And the reason for that is because the IRS regulates how these policies work. And there's something called the MEC rules. So at some point, you're going to be limited to how much you can put into this thing for what it's designed at. Now, the policies we built today, that $25,000 would be able to go in for the next 10 years. And then in the 11th year, it's going to drop down. But in this example, after the 5th year and the 6th year, that $25,000 was required to drop down to $10,000. But look what happens. They put $10,000 in, immediately have $13,000 to pull back out. So that's a 30% cash on cash return in the 6th year of this policy. That's very, very strong. And then what they wanted to do, this chiropractor was like, well, I love this strategy. I love putting my money in my own bank. I want to put more than $10,000 a year in. So how do you do that? If it'll only hold $10,000 a year, you guessed it, you open up additional policies. So you can open as many policies on yourself as you want that you can qualify for. You can open them on your spouse, on your kids, on your grandkids, etc. So that's how you start building your banking system. We max out the first policy and start opening additional ones and stacking policies to grow your banking system. And that's exactly what this chiropractor is starting to do in the 6th year. And we can start doing that in the 1st year. We can start doing it in the 6th year. It's up to you. You're in control. All right. So same thing, $82,000 available from all of this, pay off the house. We now have no money going to third-party debtors. All of that debt is now owned by our own bank. So what are we going to continue to do? We're going to continue to make these monthly payments, but instead of giving all that interest and money to everybody else's banks and everybody else, we're now going to keep that within our financial lives and our banking system, where it's going to grow for us and stay within our family's futures forever. And this is how you start creating a legacy. This is how you start compounding your money. So if you liked how we just paid off that debt for that chiropractor, we will do this for you as well. Like I said, we hold your hand, we offer all the support. So this is what we call our debt map. So if you have any debt you're looking to pay off first, one of the first things you do is after you're approved, you go through the application, you get approved, you start the policy. The next day, you go to what's called our mapping team. And our mapping team is going to do a cash flow analysis. They're going to look at all your debts. They're going to look at your banking system, and they're going to design this debt map for you so you can do exactly like the chiropractor did. Just follow the plan, follow the map. And we do this for you free of charge. We don't charge for any of this, just so you're aware. We get paid from the insurance companies, so we don't need to charge you to do any of this stuff. We get paid a reduced commission from the insurance company to give you all these benefits, but nonetheless, that's how we get paid. So we do all of this. Like I said before, we educate, we support, we eliminate all fear, and we show you exactly what to do. It's what I like to call a financial GPS. Where are you today? Where do you want to go? What's the best way to get you to where you want to be? And that's how you're going to start accomplishing more of your goals financially. Have a plan and have a map. So what if you don't have any bad debt? What if you don't need a new car? Can you still do this? Should you still become your own banker? And the answer is, oh, hell yes, because this is where it starts becoming fun. This is where you can really start building and creating wealth. In fact, we build and create wealth multiple ways. And this is all stuff we teach. I told you guys earlier about some of the other webinars that we do, some of the other events that we do, trainings that we do. This is what we teach through Money School. So Chris and I can teach you how to get into real estate investing, active or passive, private money lending, private funds. Like I said, crypto. Spencer's joining us tomorrow on Wealth Webinar to talk about crypto. We have one of the top note investors in the country, part of our network. Stocks and options trading, become a business owner, private funds. There's so many ways to create and build wealth. And we're going to use our policies as a complement to doing all of this to multiply our wealth. This is how we start creating wealth. So this policy right here is with Lafayette Life Insurance Company, one of the companies that we use. This was a policy I designed for a female real estate investor. She was 41 years old, and she wanted to put $150,000 into the policy, but she only wanted to put $50,000 annually into it. So one of the things that I can do is I can design a policy for you where we get a larger amount in the first year. It's what we call a dump in. Now, why would you want to do that? Well, in her case, she's a real estate investor and just cashed out on one of her properties and had a bunch of money just sitting there in her bank, in her checking account. So again, why would she want to make the bank rich when she can make herself wealthy, right? So let's dump the money in there. But she didn't want to do 150,000 every year. She only wanted to do 50,000 a year. So we dumped the extra 100,000 in the first year and then created the 50,000 a year policy from that point forward. Look at the 11th year, how it drops down. Remember I mentioned that a second ago? Look over here at the cash value. So you can see how this thing grows over time. So the first year she puts 150 in, she can pull 132,000 back out to use. The second year she puts 50 in, she has 48,000 of that 50 available to pull back out to use. Look at this. The third year, 50,000 goes in. She now has over 50,000 to pull back out to use. So she's already in positive cash on cash territory in the third year. And you look how this thing grows. As she puts 50 grand in, how's this thing grows? Look at this down here. In the 12th year of this policy, she puts $17,000 in. It grows by over $47,000. She makes over $30,000 in profit just by putting 17 grand in and doing nothing. Remember? You're not working any harder. You're not working any longer. You're not taking on any more risk. Just where the money goes first. Here's another policy design. So he wanted to put $50,000 in up front and then just start putting $500 a month in. So dump 50,000 in, started putting $500 a month in. The first year has over $51,000 to pull back out to use, dumping in 50,000 and doing 500 a month. And you can see how this thing performs over time. So here's a little flow of the money. So this is the policy. Remember, like I talked about before with the segregated bank account. So let's say you want to do a private money loan. So you take the money out of the policy. Now, when you take the money out of the policy, you do pay the insurance company for pulling the money. So that's going to range anywhere from like 3.5% to 5%, depending on the company. So whenever you take the loan, you're going to pay the insurance company simple interest, 3.5% to 5%. But again, it's depreciating balance. It's simple interest, and our money's sitting here compounding at a higher rate even. So if you think back to that earlier example, and we start talking about spread, right? So we take the money from the policy, it goes into that segregated account. From the segregated account, it goes to the private money loan. In this case, it was a loan at 12% that I found through the Private Money Club. The Private Money Club, just so you know, it's just a community of borrowers and lenders that Chris and I built and put together. So you can check it out, privatemoneyclub.com, and I'm happy to answer any questions about that as well. But I found a deal in there that was offering 12%, secured in first lien position by the real estate, by the asset that was worth a lot more than what the loan was. And they pay 12% annual returns. So I have monthly interest payments coming in. I take the spread. So if I'm paying 4% to the insurance company and I'm making 12%, that's an 8% spread. So I keep the 8% as profit, and I put the 4% recapture money back into the policy to reduce that balance. So I'm paying less and less as time goes on, and it's just recycle and repeat, right? So I'm making that spread. I'm getting the money back in. Once my principal comes back, I'll dump that back into the policy. Now it's ready to go for the next one. So just rinse and repeat over and over. So just a quick example of how money flows from the policy into an investment. Here's an example of what that looks like. This is the policy I just showed you. So let's just say it's the 8th year of this policy and this person wants to do a private money deal. So let's look what happens here. They put $48,000 into the policy and it grows by $66,000. If I do the math, that's a $18,000 growth, and it's a 37% cash on cash return on our money that year. Keep in mind, this is tax-free as well. So really these returns are higher. But now let's say I do a private money deal at 12%. So what just happens? I made 12% on my private money deal that year. My bank made a 37% return on my money that year. I paid 5% to Lafayette Life Insurance Company to use my money that year. So I made a 44% return on my money that year by doing a 12% private money deal. So think about it. If you were to take that same money, do that same deal from a traditional bank account, a checking account or a savings account or a business account, you're going to make the 12%, and that's it, right? That's great. But by doing it this way, we're making 44%. So which one would you rather do? And remember, we did nothing different except where our money went first. That $150,000 that she made on a real estate deal, that $50,000 a year that she has, that she's able to save, that money has to go somewhere. It can go to someone else's bank, or it can go to your bank. Would you rather make 12% returns or 44% returns? The answer is simple, right? We did nothing different except where our money went first. We're not taking on any more risk. We're not working any harder. We're not working any longer. Just where our money goes first. And by the way, that death benefit is also tax-free, creates the legacy. The loans never have to be repaid. The internal growth is tax-free. The policies are exempt from judgments and liens in most states. And I didn't really talk about this, but there's a lot of uses for business where we can lend our companies money and we can use it in the business, get a tax deduction. We can have company-owned life insurance policies where the company funds these. We can do key man policies, golden handcuff policies. We can create incentives for employees, executives in the company for later on. We can create income replacement strategies for retirement using the strategy, these policies for executives in your company. So a lot of different things we can do with business uses that I just didn't really have a lot of time to talk about, but we can talk about on a phone call. And then kids policies. These are one of my favorites. Funding college using this strategy, starting a business when your kids are younger for them, buying their first car. That's what I'm doing with my son. I started a policy last year when he was 5 years old. We're going to use it to buy his first car and recapture all the money. We're going to use it for college expenses and other things in college if he goes to college, or if he wants to start a business or do something like that, he'll have the money available. Now, the only way I'm going to give him that policy that I started for him is if he understands the concept, if he's financially responsible. And if he proves to me that he's financially responsible, then he's going to have a nice little bank to get his life started with. And that thing at that age, when he gets to that point, that thing is so efficient and that compounding is so strong. It's a beautiful thing at that point. So take care of your kids. All right. So this is no longer stuff that we're going to use as excuses. We're going to mimic what the banks do. We're going to mimic what the wealthy do. We're going to eliminate all this BS from our lives, and we're going to set ourselves up for success. Warren Buffett, he loves to keep things simple. If poor people would just do what rich people do, they wouldn't be poor anymore. So ask yourselves these two last questions. Looking at everything I've told you here right now, are you better off with or without one of these policies while you're alive? And are you better off with or without one of these policies once you die? And if you can answer to those questions, you're better off with it, then I'd love to talk with you. So from here, I want to help you get set up with this. I want to answer your questions. I want to get you going. So what you'll want to do is you'll either want to go to this site right here. I'll put it in the chat box. And when you go there, not only will you get those free digital books, as well as all the other bonuses, but you're also going to get my call calendar. So schedule a call so we can sit down for 30 minutes on the phone and we could talk about your situation and I can help you get this going, okay? Or if you don't see any call availability on there that works for you, text me. That's my cell phone, okay? I have my phone with me all the time. That is my personal cell phone. Text me. Say, hey, Stephen, I watched your presentation. I want to start a bank. I want to start a policy, or I have questions. I want to talk to you. And we'll find a time tomorrow, Thursday, Friday, next week, over the weekend, evening, morning, whatever. Let me know. I'm here for you. Like I said, that's my commitment. I'm committed to helping you get this going no matter what. And let me see what questions have come in, and then we'll go ahead and wrap for the day. All right. So Anonymous asks, when or where is the interest paid calculated when paying back a policy loan? So the insurance company tracks all that, and they're going to let you know once a year how much interest is due throughout the year. James said, is the debt map built through the Truth Concept software? It's not, James. I'm not familiar with that software, but our mapping and system is all done through proprietary systems that we've built through the Money Multiplier. Madeline, yeah, the deposits will go to zero. We can do it anytime after year 10. We could probably do it earlier if we needed to. So if that's what you need, Madeline, just let me know. We can definitely set that up for you. No problem. All right, guys. Well, I don't see any other questions coming through. So like I said, if you need anything, want to schedule a call, want to talk, please do so through my calendar, or if needed, send me a text message. I look forward to working with every single one of you. I hope you have a great day, and make sure to join us tomorrow for What the F Happened in the Morning, the Wealth Webinar Series at 1 p.m. Eastern, and our Ask Me Anything at 4:30 Eastern. All right, guys, have a great day. Thank you. See you soon.